Franchise 500 recently released their 2023 list of the top 500 franchise brands in the United States. We're going to go through today which of the top 50 franchises don't deserve to be on the ranking. They don't deserve to be on the top 500, period. So for those that aren't familiar, Entrepreneur's Franchise 500 list has been the gold standard for franchise marketing to franchisees for over 30 years. If you go through the physical magazine, they have tons of advertisements for the franchises on that list, right next to where the ranking is for that franchise. Franchise development folks, brokers, salespeople have been boosting how their brand is on the Entrepreneur 500 list. But is it even that impressive? I would argue no. It's a list that it's self-selecting. You apply to be on the list. Every year there's 1,000, 1,100, 1,200 franchises that apply to be on the list. So about half get it. For me, there's not so much to be said if you're the best 50% of franchise brands. It's something that's interesting, but to be on the top 50% of franchise brands, it shouldn't elicit someone to go invest in that business, forego the due diligence, move forward through the process super fast. It's something that's interesting and isn't a red flag to be on the list, but definitely you've got to dive into the franchises, whether you're working directly with an advisor or not. You take ownership over the process. If you're looking to buy a franchise, the Franchise 500 list, from what we've seen, does not have you as top of mind. Think if you have $100K, $200K to invest, the bunch of the franchises on the list you can't even get into. And forget the top brands right now like Crumble Cookies, as they're not even on the list because they're not submitting to be on the list. Seven Brew, another franchise that's growing like wildfire. So the top franchises that are pretty exclusive to get into, they're not even on the Franchise 500 list, especially not this year in 2023. So going through the list, I'm going to go through 10 franchises that don't deserve to be on the top 50, and I would argue don't even deserve to be on the top 500 for their list. So first up is Taco Bell, founded in 1962 in California. Tex-Mex, 2 years after opening the first Taco Bell store. Glenn Bell began franchising, starting with Kermit Becky, a retired LA policeman, opened his own Taco Bell location in Torrance, California. Today, Taco Bell is a subsidiary of Yum! Brands based in Louisville, Kentucky. Yum! Brands has over 6,800 franchise stores in the United States, as well as another 500 internationally operating under Taco Bell. The initial investment to get in, $1.3 million to $3.3 million. If you're reading Entrepreneur 500, only 1%, 2% can even access this brand because you also generally have to develop 5 to 10 locations. So pretty high upfront costs. They also have an express franchise model, $227,000 to $590,000. However, they've closed a significant number of those locations. The last research we had was 20% plus locations failed over the prior 3 years. When you go to sell your Taco Bell, so imagine average sales 1.6 million, the multiple, you're probably going to get 500K, 600K. That's significantly lower than the midpoint investment of $2.3 million to open up a Taco Bell. Maybe if you have 10 locations, it will sell at a better multiple, but you're still most likely not going to recoup your money from Taco Bell, looking at information provided by the FDD, as well as what we've seen for valuations for Taco Bell, as well as related quick service restaurants. Next up, you have Kumon, another franchise that's been around quite some time, was founded in 1954 by Toro Kumon. He developed the Kumon method in Japan. We estimate the initial cost to be higher than the FDD, given the time it takes to break even. Could set you back $80,000 to $160,000 plus. Could even be closer to $200,000 depending where you open up. So instead of having a standard percentage royalty fee for Kumon, they charge per subject. At the end of the day, the royalty fee is super steep. We're talking 25%, 30%. That's calculating if the average tuition is about $130, $140 a subject per month. This fee is pretty high in education. Education generally has a higher percentage royalty, but I haven't seen anything this high. We did see a decrease of Kumon centers in 2020, more than 25%, largely due to COVID-19. The business model in 2022 hasn't really adapted to the times, and operating in like a high-end retail space, the model just does not make the top line revenue you need to pay for that rent. So to sign a $5,000 a month lease, $6,000 a month lease, you need to be hitting $400K, $500K plus, where Kumons regularly have $200,000 in revenue, $250,000 in revenue. Kumon owners regularly work full time, and we estimate that they're making $30K, $40K, $50K, with some of the top operators clearing $100,000 a year in the business, but many of them, the majority, falling short of that. Number 3, we have KFC. KFC was founded in 1952. Again, it has a great brand. That doesn't mean it's a great franchise opportunity in 2023. Today, KFC has over 20,000 stores in 145 countries. In 2021, KFC, the parent company, had a really nice operating profit of 33%. And if you look at what the franchisee makes and their operating profit, closer to 8%, 10%, 12%. So the franchisor, KFC, which is owned by Yum Brands, they make great money, awesome profit margin, 30%, 33%, 35%, depends on the year. However, you as a franchisee expect a 10% profit margin. Could be less, could be more. We'll see how labor, food costs do. And that doesn't even include debt servicing, where interest rates have gone up quite significantly. Total investment amount, $1.4 to $3.1 million for KFC. Royalty is not so bad, 4 to 5%, but they have a national co-op fee of 4.5% that adds on top of that. So even giving them the benefit of the doubt, operating at KFC at a 15% profit margin, based on initial investment at $2.3 million, we estimated taking 12, 13, 14 years to recoup your initial capital investment. If you're a real estate developer, you build the land, flip the land, then building, you can recoup your money fast, but still, it's going to be quite some time until you get your return on capital for opening up a new KFC franchise. Number 4 is 7-Eleven. They began a long time ago, 1927. Years back, they were number 1 on the Entrepreneur 500 list, I believe in 2018. Great branding. Investment amount's going to range anywhere from $50,000 to $1.1 million to open. The company franchise fees, $0 to $1 million. Essentially, most of the time, you're just buying a 7-Eleven that's already in operations directly from the corporation. Their revenue model's kind of tricky to go through. I don't like how they're charging a percentage of your gross profit, a pretty significant, not the operating profit. If it was like the Chick-Fil-A model, you get 50%, they get 50% for 7-Eleven. They're taking it higher up on the income statement. And there are some 7-Eleven franchisees that make a lot of money. However, there are many 7-Eleven franchisees that just scrape by. Number 5 is Snap-on Tools. Founded in 1920 in Wisconsin, the company has grown quite a lot over the years. You have to have a minimum net worth of about $40,000 to open up a Snap-on. All different ways to finance your franchise mobile store, where you'd be selling high quality repair and diagnostic tools and equipments. Snap-on manufactures the tools, and then you as the licensee, you as a franchisee, are responsible for distributing the tools and equipment to mostly professional mechanics as well as some other tool users in the United States. In the last 3 years, Snap-on has seen a decline in the franchise-owned units. Company-owned units have also been in decline, except in 2019 when the company opened 33 units in 1 year, or you could say took over. The failure rate is super low. However, the transfer rate is off the chain for Snap-on Tools. So they don't let the licensee fail. Rather, they take it over, assume it as a corporate location, then resell it, or someone in the franchise system buys. But we're talking about super high transfer rate. And if you want to dive into the numbers, I encourage you to go to vettedbiz.com. Just type in Snap-on, and you'll be able to see the transfer rate over the prior few years. Number 6, F45. Darling of the fitness IPO market. When they IPO'd a couple years back, the stock went up and it went down to $2, $3. The CEO, Adam Gilchrist, left the company, had a nice golden parachute, made millions of dollars when he left. The system was started in Australia in 2012. They have over 2,300 franchises sold in 63 countries. We have serious doubts that they're going to fulfill all those openings, and F45 franchisees have to pay, even before they open, in franchise fees, equipment, and other fees, over $200,000 to the franchisor, and that's before they even open. Number 7, Pizza Hut, started in 1958. By 1971, Pizza Hut became the #1 pizza restaurant chain in the world. So didn't take them that much time to become #1. However, they've struggled to keep that #1 status, with Domino jumping up, as well as competition from Papa John's and Little Caesars. Pizza Hut is another subsidiary of Yum Brands. They have over 6,000 franchise restaurants in the US and another 11,000 across the globe. Pizza Hut can make sense in certain locations. However, there have been a lot of closures, with over 1,000 closures just in the United States for their traditional locations. So think, that physical building that has the red bricks on the top, and then also the non-traditional locations. There were a lot of closures in airports, especially in light of COVID-19. Next up, Dairy Queen, founded in 1940, over 7,000 locations across the world. They have different models. The grill and chill, it's going to set you back $1.4 to $2.4 million. At the end of 2021, the average Dairy Queen reported gross sales of $1.4 million. If you think about a profit margin of 10, 15%, that's not too much money left for you at the end of the day. The Sonic has a similar story. Started in the 1950s. As of today, 2023, they have over 3,500 Sonic restaurants operating in 46 states in the US. Most are owned by franchisees. You have about 8-9% that are owned and operated by an affiliate of Sonic, the franchisor. Their EBITDA, so earnings before interest, taxes, depreciation, and rent, seems good, 22.9%, but imagine you're paying 8, 9, 10% rent. That could just be 13% down to you, 12% down to you. If you have debt servicing, we're talking about net profit margin for a Sonic restaurant in 2023, our expectation of like 5 or 6%. So unless you're making a ton of money on the real estate side and you're selling that out to potentially a REIT, I don't see how it makes sense to open up a Sonic in 2023. Rounding out, you have Baskin-Robbins, again, was on the top 50 of the Franchise 500 list. Based on a midpoint investment for Baskin-Robbins of $358,000, we estimate profits about $60,000 on a 15% profit margin. When you go to sell that Baskin-Robbins, though, we think it would sell for $180,000. So the midpoint investment amount is $350,000. So similar to many restaurants like Subway, you invest $350K, you can expect to just make $150K, $200K back. You don't get any money for your sweat equity. I don't see how the numbers add up. So those are just 10 franchises I went through that don't deserve to be on any top 500 franchise lists, especially the top 500 franchises that prospective franchisees should be considering in 2023. Let me know if there's a franchise that you saw on that top 500 list that you'd like us to review. Happy to dig through it for you.